if you invested just $1 in Apple Inc. back in 1980? Today, that tiny investment would be worth thousands of dollars. Let's break down exactly how it grew and what it teaches about investing. In 1980, Apple was a small computer company founded by Steve Jobs, Steve Wozniak, and Ronald Wayne. Personal computers were still new, and very few people believed the industry would become huge. But Apple had a big vision to bring computers into everyday homes. Apple went public on December 12, 1980. The IPO price was about $22 per share. At the time, the company was valued at about $1. $8 billion, which was already considered massive for a young tech company. But what happened next was extraordinary. Over the decades, Apple performed multiple stock splits. Stock splits increased the number of shares investors own while lowering the price per share. Apple splits happened in 1987, 2000 to 2005 to 2014 to 2020 because of these splits. Early investors ended up owning many more shares than they originally purchased. If you invested $1 in Apple in 1980, your investment would have multiplied dramatically. After accounting for stock splits and growth, that single dollar would be worth thousands of dollars today. But if someone invested $1,000 instead of $1, the return would be millions. This is one of the greatest examples of long-term investing in history. Several key innovations drove Apple's growth. Major products include the Macintosh computer, the iPod, the iPhone. The iPhone alone transformed the entire smartphone industry and made Apple O. Near the most valuable companies in the world in 2018. Apple Inc. became the first publicly traded company to reach a $1 trillion market value. Later, it crossed $1 trillion and even $3 trillion at times. That growth rewarded investors who stayed patient for decades. The biggest lesson from Apple's story isn't luck, it's time. Investors who bought early and held their shares allowed compound growth to work for them. This is why long-term investors often focus on great companies, long holding periods. Consistent investing means investors now use index funds tracking the S&P 500 to capture long-term market growth. Many people try to trade stocks quickly, but the biggest returns usually come from holding great companies for decades. The problem is that patience is difficult. It's much easier to chase short-term trends than to wait years for investments to grow. The story of Apple shows something powerful. Small investments can become huge over time, but the key ingredients are time, patience. Consistent investing decades sometimes, the best investment strategy is simply holding great companies for the long run.